Here we go. Let's finish chapter 6 so we can have a test, finally. Alright, so where we left it is we were looking at how to value stocks, but not all companies have publicly traded stock. You can value privately traded or a private stock in a very similar way as you would go about valuing a publicly traded stock. And the stock price is supposed to be the market's assessment of how the firm is operating, what the firm's financial condition is, and what the market thinks of management's strategy. Okay? But it is more difficult to get information from privately owned banks. There are other measures that we use to determine, assess how banks are performing and how they are positioned financially. All right, so we'll look at some of these ratios, some of which we've gone over in other classes, but there are some that are unique to banking. So first, return on equity, something you're familiar with. Net income divided by average owner's equity. So what is the return on the equity capital that is being risked? Okay? And so it reflects all of management's decisions, including the ability to capture yield on assets. So we're looking at net income. How does a bank make net income? Capturing yield on assets, minimizing operating expenses and interest expenses, and deciding how much leverage to employ at the bank. Okay? Then return on assets, net income divided by average total assets, and it measures the yield earned on assets. It does not include leverage. All right, here's a ratio that analysts look at very closely that pertains to banks only, the net interest margin. Okay, so we looked at net interest expense. Now we're looking at net interest margin. So here's net interest expense, net interest income. I'm sorry, in the numerator, and we're going to divide it into average total assets to turn it into a standard unit of measure that we can then use to compare from bank to bank. Okay, and this measures the job management is doing, generating yield compared to the cost of funds and compared to how much dollar value they have invested in assets. So basically we are taking our net interest income and turning it into a standard unit of measure. That's what this is. Here you go. Dividing interest income into assets enables you to compare this number across different size banks. How's a large bank doing relative to a small bank in terms of generating net interest margin? Okay? The net interest spread is the average yield earned minus the average yield paid. A little bit different way of looking at it. So how is management doing managing intermediation? Okay, what does that mean? Earnings on loans and investments versus payments on deposits and on bonds. Okay? So the average yield earned is your total interest income divided into total earning assets. The average yield paid is total interest expense divided by total interest-bearing liabilities. So this is the spread. All right. Net non-interest margin. Okay, this is where banks start looking at the contribution being made to income and profit and cash flow by non-interest activities. Okay, so you take your non-interest revenue, subtract your loan loss provision, subtract your non-interest expense, and divide this into total average total assets. Okay? So once again, we're looking at the non-interest income revenue, fee revenue, and how the fee revenue contributes to paying other expenses at the bank. All right, then net operating margin, and you guys need to pay close attention to these formulas, because you're going to have to do some calculations, and so you're going to need to know these formulas. Net operating margin is operating income divided by average total assets. Okay, now remember, operating income looks different in a bank than it does other firms. Okay, so go back to chapter 5 to look at operating income. Okay, here's a biggie, and Andrew talks about it early on. The efficiency ratio. This is something that the accountants look at really closely. I kind of roll my eyes because it's all about controlling expenses, controlling expenses. That's what accountants do. They like to control expenses. Well, it's important to control expenses, but it's more important to grow your revenue. Okay? Total operating expenses divided into total revenue. Okay? Then employee productivity. Divide your operating income by the number of full-time employees you have to determine revenue per employee to see how productive you're being. Okay? So, man, there's a lot of stuff on slides 13 and 14. All right, some other things that analysts look at. The net interest margin or spread. Okay? Asset utilization. Okay? Let's see where I want to take you with this. This is the efficiency ratio. Here's one. Here's an interesting ratio. It's a measure of risk. Non-performing loans divided into total loans. Okay? How's the bank doing collecting on their loans? This is a reflection of collections, but it's also a reflection of the work that the bank does on the front end before they ever decide to extend a loan. Okay? The loan loss provision divided by total loans is another way of determining whether the bank is adequately reserving. Okay? And then total assets divided by total equity is a leverage ratio. See where we're going here. All right, so some risk considerations. Credit risk. What is credit risk? Okay, this is the risk that borrowers will not pay back their loans. A lot of work is done on the front end and by analysts, and we're going to get into loan applications. Okay, the requirements that banks have for to extend a loan. Liquidity risk. Okay, will the bank have enough cash to pay their bills? Okay, or to cover withdrawals. Interest rate risk. This is a biggie, and there's a whole chapter on interest rate risk. Okay, the risk that interest rates will change. If interest rates change out there in the economy, and we know that they do every day, okay, this would impact the prices of bonds that the bank holds, and also impacts the earnings spread. So we're going to take a closer look at that. Legal risk is a big risk. The risk that the bank will damage an employee. Okay, someone could get injured, or there could be inappropriate behavior. A vendor could be injured, damaged in some way, customer, okay? Or you get into a dispute. So there are lots of legal risks involved with owning businesses and operating businesses. Compliance risk, the risk that the bank will fail to adhere to bank regulations. So banks have to employ compliance people to make sure that they're complying. All right, and then financial risk, will the bank have adequate capital to cover any loan losses or operating expenses? So banking is profitable Banking is a good return business to be in, but there are risks involved, as there are with all businesses. All right, let's take a look at the components of return on equity for all FDIC insured institutions from 1992 to 2009. All right, let's see how the return on equity is earned. Net profit margin, okay, with asset turnover and leverage, okay? So, first thing I want to show you is that return on equity for most banks runs somewhere between 12 and 15%, and that is pretty standard, okay? Now, it started dropping off in here as loans started going bad, okay? Banks got a little too happy, a little too aggressive, and this all led into the financial crisis of 08 and 09, okay? And you can see that the big drop off here in 08 and 09 was in the profit margin because loan loss provision had to be jumped up so much, okay? And asset utilization didn't change a whole lot, which is revenues divided by total assets, okay? So that didn't change much, but the profit margin sure did because of loan loss provision, okay? And then you can see that leverage didn't change a whole lot during the period, okay? So the big change was right here in your profit margin. And that came from writing down loans. And also, lending dropped off as well. All right, return on assets, okay? Same period of time. So we have total interest income divided by total assets, okay? And so we see that in most periods, so this number here shows what we generate, okay? But it doesn't show the expense. And so you can see that somewhere between, typically between 5 and 7% there. And total interest expense typically somewhere between 2.5% to 4%. Okay? And then you can see the margin, net interest income divided into total assets, is typically around 3.5%. Okay? Then you have your provision for loan losses, which is typically less than 1% until boom, okay? And let's see. So there's your loan loss. There's your non-interest income. Didn't change much. Non-interest expense didn't change much. Okay. But your operating margin, your pre-tax operating margin, typically around 1.5%, 1.75%, and then you see it turn negative. And you had securities losses here, okay, versus pretty flat most of the time. And then you see down here your return on assets, which return on assets, again, most banks target 12, 13% return on equity and 1% return on assets. And you can see in here that things got a little happy up around 1.3, 1.4%. return on assets. That means things are too bubbly. They need to be down in this range here to be sustainable. And then you can see that there were losses here. All right, so where do we get information for banks? A couple of different places. First, the Uniform Bank Performance Report and Bank Holding Company Performance Report. Okay, and these are available to the public, and analysts pore over these numbers to try to get as much detail as they can. Okay. So you get a lot of detail about how the banks are doing. Okay, and this is where you can go to find these reports. And I've got a good mind, since we're not in class anymore, I've got a good mind to maybe ask you to do a report to find some of these statistics for a bank. Right? I'm going to think about that. In the meantime, we are done, and I would ask you to look at Chapter 6 homeworks. All right, and then we'll talk. I'll send out an email later this afternoon about the exam. Peace out. Shalom.